How do you get through tough times? Hey, this is CeoTrades, where money works for you. Today we're looking at a very important question. How do you get through hard times? Hard times are upon us. Actually, the reality is, when haven't hard times been without us? In other words, hard times exist, but only those who prepare and learn from their past mistakes move on. For example, when there's an airplane crash, which is very, very rare, what happens? The CAA or the FAA, they study what happened. The National Transportation Administration goes out there and collects every piece of clue in order to find out what exactly happened. Well, guess what? When hard times hit, did you know that you could study and see what is going on, how did you go wrong, and how you can make it right the next time around? And that's why we're looking here at a chart of the U.S. bull and bear markets since 1926. And you can see here that in the blue, that's every time it's gone positive, it's been bullish. And then here in the yellow, you can see every time it's gone bearish, much smaller. What is the difference? How do I benefit from this information? Number one is we're going through hard times right now. It's pessimistic time. A lot of things are highly inflated in reference to pricing when you go out there and purchase. But then there are other things that have come down in price. Why do some things go higher and why do other things go lower? Well, for example, gas prices are somewhere between $3 and $4 range, low $4 as what I've seen across from Georgia all the way to New York. I've seen that most places are in that range. But then diesel prices are at least 50% higher. How does this work? Well, unless you do the research and read and find out what and why this is happening, you're not going to become aware of it. Or unless I publish it here, one of my moments that I get a chance to talk about these situations, you're not going to find out. It's the same thing here with this chart. How are you going to find out what's going on without having someone explain to you what this means? Number one is that you can see since 1926, we've had down times, hard times. All of these in yellow are hard times. But in comparison to the blue, they are much less. You can see here that at the beginning of 1926, it went up 3.7 years. It went up almost 200%, to 193.3%. And then it went down for 2.8 years, almost a similar amount. And that is about 47% downward trending. And then it went back up to 91%. And then after that went down almost 28%, 29%, and then back up 265%. You can see that same type of pattern going onward and onward. How do I benefit from this information? Well, number one is there are two types of traders out there in reference to investing. There are those that are passive and those that are active. The passive ones will do a type of trading that is called dollar cost average. What does that mean? Compared to long-term value investing. What does that mean? Well, let's take a look. First of all, I want to show you different parts of this chart. Number one is that in overall, the markets have been down 14.7 years since 1926. But at the same time, it's been down 14.7 years. The market has been up bullish 75.4 years. See, the more you study this chart, the more you study history, the more you're able to understand what's going on. And that's why I had the explanation of what happens when a plane crashes. Every piece is put together, finding out what happened, how did it go wrong, which screw came off and led to everything else going haywire. Well, it's the same thing in the stock market, the same exact thing. You can see that governments go into this whirlwind of spending, and then all of a sudden, boom, things go into hard times, and hard times are just part of life. Now, if we took the time to study this, like very few of us do, and that's why very few are successful, is because we don't sit down and ask ourselves these important questions. Why is the market downward? How can I benefit from this? Where can I have an entry point that will give me the benefits of the down? Well, you can see here that in year-by-year returns for the bull markets, since 1949, that in 1 year between 1949 and 1956, that's almost a 6.5 year span, almost 7 years. 40% was gained in the first year, 14.2% in the second year, 12.9% in the third year. You can see that most of them are green. The yellow ones, obviously, just in general here, you can see these two, they've had minus returns, but you can see down here, the yellow ones are not that great of a return compared to the greens. And some years you've had no returns, which is where these X's are in this question mark. Now, how does this benefit me? It tells you and me that although things may look horrible, may look like they're not going to come back into positive territory, price fluctuations are part of investing. Price fluctuations are part of investing. You see, the deep psychology that is involved in this is getting people into fear mode. And there is obviously a chart that measures people's fear, because you can tell who's trading and who's not. All this is information is available. And the higher you are in the investing world, the more information you have, the more statistics you have on people just in general. Now, Warren Buffett tells people buy low, sell high. Well, so does Charlie Munger. And one other person I want to add in there is Sir John Templeton. Now, I learned about Sir John Templeton through Tony Robbins about 6 or 7 years ago. And through his book, I found out that Sir John Templeton actually became who he is, or is remembered by, because he invested in the most pessimistic of times in penny stocks, in stocks that were supposedly going to go bankrupt. But how did he do this? He just picked, he put $10,000 in, and he just picked penny stocks all across the sectors, maybe in the financials, maybe in commodities, transportation, construction, real estate, and so on, and on all the levels. Why? Because the better diversified you are, the better prepared you are for the weather that is coming, because winter is here, and most people don't know that in order to prepare for winter, you have to be invested in all parts. And that's why I say, God forbid a plane goes down, every single part is collected and studied. Every single part is collected and studied. That's where the key points are. What does that mean? Invest in every sector. You don't have to be a millionaire to invest in every sector, but a clear investment is a good decision, meaning try to invest in companies that are not in debt or minimal debt, because they're the ones that are going to survive through these crashes. There are going to be some that are going to go bankrupt. That's just unfortunate, but it has happened. And most of us have gone through this and have seen it. Run away from clear chaos. If you know that a company is just way in debt, then don't invest in it. I mean, for example, that have minimal to zero debt, Google and Meta from Facebook, they have minimal debt. However, right now is a pessimistic time and people are staying away. But guess what? Those who study the patterns know that these are the types of companies you should be investing in. Now, dollar cost average, what does that mean? As I bring up this chart here, you can see that if you would have invested in the lowest point of the stock market back here in 2020, which is, I believe was March of 2020, until now, you would have made around 60% gains. But can you imagine you would have invested here before it went down? You would still be making money, but not as much. You would be making about 9%, which is the average, about 9%. So you'd still be making money, although we want to invest down here. What's the difference? You see, dollar cost average is when you invest in different sectors. Like here, you just put 1,500 throughout certain periods, and you're just averaging in. It might be at the highest point, at the lowest point. What's the difference? You're buying at the cheapest point here. You might get 300 shares of a stock down here, but up here you might only get 100 shares. Now, this is dollar cost average, but in compared to long-term valued investing, you just go back and check out this chart and you'd invest at the lowest possible point. It could be anywhere in this area, anywhere, including now. It might be down enough that you'd want to invest in. And long-term valued investing basically means you try and pick the bottom of the market and just hold for dear life, expecting it to make a return eventually. Now you can see here that from March 2020 to now, we don't even have full years, and it's 60% compared to what it was. Would you have cashed in? You could have. Would you keep riding it? Well, can you imagine having cashed in up here? You would have made so much more just at the beginning of 2022. But most of us just let it ride. We're passive investors, and we don't know what's going on until it's too late. And what happens? We all like to invest when people are saying, wow, I'm making money. They want to invest up here. Now you're all lost. That is the reality. You see, when you're looking to make money, you've got to invest in your knowledge account so that your bank account will grow multiplied. And remember, a passive investor will just let the market take advantage of their money, while an active investor will allow their money to work for them while they're watching it. Until the next one, we'll review another session of the markets.